G'day and welcome to this week's video. My name is Robert Gowdy and this week we're going to have a chat about managed funds and the tax outcomes of these products are not always ideal, and I'm going to look at them from a point of view of perhaps from non-superannuation assets, that they're not the most ideal structure to own your assets. And the reason for that is many years ago, and this is probably going back close to 15 to 20 years ago, where we would invest money into a managed fund and might do it at between the start of June and mid-June, so near the end of the financial year, and we would invest an amount of money in the person's individual name outside of superannuation. And because managed funds are generally a unit trust, at the end of each financial year they need to distribute all their income and capital gains that were realised throughout that financial year. What happened very early in the piece of my career was a client was invested start of June, so they were there for a heartbeat, and at the end of June they received obviously quite a substantial realisation of capital gains, which was there to be taxed. So this person was there for an absolute heartbeat, not even 1 month. And yet they received a substantial amount of realised capital gains in addition to the income that the fund had earned for the previous 6 months or so. This had a negative effect on personal taxation, so low income tax offsets, extra tax to be paid. It affected Centrelink payments as well for that year, and this client had only been there for such a short time. So essentially what happened was, this managed fund could have been running for, I think the fund that I may have used might have been the old Colonial First State Imputation Fund, which had been an amazing managed fund with great results for many years. But as the fund manager over time had significant unrealised capital gains, which could have been accumulated over 10 years. And those unrealised capital gains, some of them were realised in that year when my client was actually just newly invested. And then that was spewed out as distributions, which affected their personal tax outcomes. So managed funds are brilliant. They provide diversification across markets, sectors and different businesses. You get the benefit of a fund manager, and they're also fantastic for fund managers because they're highly scalable. You have one product and you can keep piling people on top of the existing structure. So highly scalable and highly profitable if they get it right. But it's impossible for the fund manager to consider every individual's tax scenario at the end of each year. It's not as big an issue for superannuation because we know the tax rate within super is a maximum of 15%, and if you're retired and you've got up to $1.7 million in pension, you pay no tax. So the fund manager can do what they want there. They can buy and sell all day, every day, and realise capital gains, but it's not going to be an issue for you because you're in a nil tax environment. But when you're investing in your own individual name, that's where it's not quite as bad. Some of the other issues we have with managed funds is clearly fees. You pay for the advice, which is not a problem if there's outperformance. And there's plenty of studies done on outperformance. What we've done in the past, and this is where we change the way we invest, particularly for non-super and definitely for our self-managed super fund clients, is wherever possible we try to go directly. So if we like Microsoft and Google, which I've said before we do, we love these businesses, that when we go and buy them, we buy them today at the client's, once a client's going ahead with advice, and you inherit, you don't inherit, you get the cost price that you pay at that time. You're not going to manage fund and inheriting a unrealised capital gain from a fund manager that purchased Google 10 years ago, which would have been fantastic for the fund manager and the clients. So wherever possible, we go directly. So if we want to buy Magellan Financial Group, which is a very high quality business, they're a fund manager, and their share price is about $53 at the time, that is the cost price. And then when it comes to tax time, if we do choose to sell a business, or say a client needs to come to us and say, Rob, I need X amount of money for a particular purpose, and we identify a company, we say like the lease, but it's got capital gains within it, we can then search for the portfolio and offset that gain potentially with a company that has got a capital loss. It hasn't done quite as well, which we get with all portfolios. Not every company we recommend is always going to be a winner. So it allows us to manage that significantly as tax outcomes better. It also allows us to reduce fees if we go direct, and there's also that element of when we go direct, the clients have control, it's fully transparent, and they know the story behind each business that we purchase for them. But managed funds, ETFs, active ETFs, listed investment companies all have their place, particularly when it comes to diversification, because I can invest as little as $500 on behalf of a client's child, and that $500 is diversified across a huge range of different businesses all over the world. So they have their place, but they're not always that tax effective, and that's one of the downsides, and one that I've personally seen clients disadvantaged at different times over my career. Thanks for listening. I hope that was a help, and we'll catch you at next week's video. Thanks for listening. Bye.